Good evening, people. Welcome back. I am Craig. So in the last episode, I mentioned I was thinking of doing a Crypto for Beginners series, and I got a lot of positive feedback, more than I even expected in the comments. I guess a lot of people want content like that. So this is going to take me a bit because what I want to do is I want to do a bunch of episodes back to back to back. All of them going to be short, hopefully around 5 minutes, maybe 10 at the most, to talk about a very small component of crypto investing, something that a new person would want to know or learn before they get into this. And that way I can have topics on each individual video. So in the future, when I do an episode and somebody asks me a question that I get numerous times, I can say, that's been covered in Crypto for Beginners number 3 or whatever. And then they can go and watch the 5-minute video and get a detailed answer without me having to regurgitate the answer in the comments over and over again. I think it'll be helpful for everybody. So hopefully you think so as well. Put down in the comments whether you ended up liking this video or not. Obviously, thumbs up if you did, and subscribe if you haven't already for the further episodes. So in this episode, we're going to go through the roadmap first, and I'm going to show you what this series is going to have, and then we'll get into just tonight's topic, which is going to be the intro. What is a cryptocurrency and what are the different types? So we're going to talk about what is a cryptocurrency and what are the differences. Generally, there's 3 types. I only mentioned 2 here. One is a store of value and the other one is a smart contract type of chain. And a question that everybody will always ask is investing in cryptocurrency risky? And kind of a obviously yes and no answer there. What are the choices of the ways to buy crypto assets? So this will be the next episode after this one. What are the easiest ways to get on? And I've talked about this in previous episodes. There are definitely some easy on-ramps to get into crypto that are quick, easy. You can e-transfer the money, have the money in there within 5 minutes and get up and running. But it may not have all the features that you want from a full crypto exchange. So I'll give you the different choices and how maybe if you just want to get one coin for now, let's say it's Bitcoin, and you just want to get in quick, get your money in, get it going. You probably want to do those quick on-ramp type of places that I call easy buying sites. And then later, if you get more advanced or you want multiple coins or you want to start yield farming, you're going to have to get into a more full service crypto exchange. So we'll talk about that in another episode after this one. Next one is, what is a crypto wallet? You're definitely going to need a crypto wallet if you're not just going to go to one of those buy sites like Coinbase or Robinhood or something, and you're just going to buy one coin and you're not going to move it. Then you can just leave it on their site if you want. You don't ever need to have a wallet. But if you're ever planning to move the coin, or if you're trying to yield farm it or stake it in the future, you're going to need a wallet. And we'll talk about what are the differences between a cold wallet, an online wallet, and a hot wallet. The next one, kind of going off of that topic, will be how to set up your MetaMask wallet. Now, I'm using MetaMask myself. It just becomes so ubiquitous. It seems like everybody knows how to use a MetaMask wallet. All the different, whether you're on Ethereum, whether you're on Binance, whether you're on Medic, it doesn't matter which ecosystem you're on, you can set up your MetaMask wallet to go on each one of those. Now, there is some settings you got to change each time, which is an extra step or two that you may not know, but I'll do an episode just on that. And then, what is the best way to research a coin? I don't want to endorse anybody just buying coins because somebody at work told them about a coin without researching it. Always, always, always research it. And I've got a few free sites, that's the important thing, where you can get on there and quickly and easily get everything you need to know about a company. Its market cap, its website, its white paper, everything you need to know, and it's all free. So yeah, those sites, we'll go over that in a different episode. And then free sites to chart your crypto. Now, you don't necessarily need to chart your crypto, but sometimes it's a good idea to do it, even if you know nothing about technical analysis. Just to look at the chart and go, if it's been rocketing up for the last 2 weeks and that's the day you decided you wanted to buy it, you might look at a chart and go, that seems like it's very toppy right now. It's gone a long way in a very short time. Your gut feel is probably I'm buying at the top, and you probably are. I can go in that episode through basic technical analysis, nothing that'll scare away anybody, but a little bit of showing you how to find support and resistance and other easy to follow technical analysis. So you can try and decide whether the coin you're thinking of getting into is presently overbought or oversold. The next episode would be about describing choices, holding crypto as a store of value like a digital gold, or having it pay you like a dividend paying stock. And there's definitely people that do both. Some people just want to buy a store of value type of coin like a Bitcoin, and that's just their savings account that they just want to put away in a cold storage wallet or whatever, not think about it, hold it for 5 years, whatever they want to do. And then down the road, they want to be able to think that they can cash out later for much higher price than it is today. And that's fine. But there's people more like me that figure, well, if I'm going to hodl is hold on for dear life. If I'm going to hodl my coins for a while, why would I just put it in a cold storage wallet and not make any interest on it? There are many, many, many options to make interest on your coins. Some coins are better for that, and some coins are not so good for that. I mean, they all usually you can find somewhere to get some yield, but different coins, some have massive yield and some have tiny yield. So we'll get into that. But those are options. Some people just want to hodl and not worry about putting it on a yield farm, and some people want the money, want the passive income while they hold their coins. So we're going to give, these are kind of like subsections. Each one, this is a very detailed area. So I figure there might be one episode on each one of these things. What is staking? Staking is kind of the most easiest thing to do. You can do it on Binance. You can do it on any exchange. They almost all have a staking option where you take the coins that are already on, let's say Binance, and you just stake it. You just say, I want to park my coins with you and you can pay me some money. Simple, easy. You don't even have to get off your exchange. You wouldn't need a separate wallet to move it around. Basic. But as I've talked about in previous episodes, probably not the highest interest you can make by staking. That would be the next topic, which we'll get into. And these are very detailed topics, so they'll probably each take an episode. And that is, what is yield farming for crypto? So long and short, yield farming is more advanced, therefore a little bit more risk too, because you got to have two coins instead of just one coin, and they got to be of equal value when you put them in, and there is an opportunity for one coin to go shooting up while the other one doesn't. And then you have this thing called impermanent loss, where one coin has to make up the difference for the other coin. Again, will be a whole episode just on its own, but the long and short of that is there's more interest to be made in yield farming than there is in staking. And then even one step higher than yield farming is, in essence, from the name you can probably figure it out, it's yield farming. On certain sites, they set you up where you give a pre-approval with your MetaMask that they can take the profits from, let's say, Pancake. You know, if you put your farm on Pancake, it will pay you cake coins on the side that'll just sit there until you tell it to, and then until you make the effort to reinvest those coins. But you can go to certain sites where it'll automatically do that for you. In fact, it'll multiple times a day take your earnings, because most of these things pays you little micro pieces of a coin like every 5 minutes. And so after maybe an hour, 2 hours, 3 hours, it's actually most efficient to reinvest those coins and get them also earning a yield. And that power of compound interest is super powerful. So that is something that I do, and I will definitely show you that in another episode. And then does it matter where I go to yield farm? Should I just go for the highest APY, the highest average yield? And I wrote it right on the screen. The answer is no. Do not just go for the highest yield, because you'll probably find the ones that are the highest yield are also the ones that are the tiniest. The tiniest, just brand new, started last week exchange will offer the moon and the stars to get new customers to come to them. Oh yeah, you've got Cake Coin, we're giving 200% interest. And you're thinking, why is it 200 there when it's only 85 or 90 over there? Something's not right here. If it's too good to be true, it probably is. It may not be that new exchange is going to go bankrupt or anything like that, but they're so new that they're so desperate to get customers to get that total locked-in value higher that they're, in essence, giving away all sorts of bonus coins. And you can take the risk. Again, risk-reward thing. Take the risk, go to one of these tiny little AMMs and get the higher interest and just hope that nothing goes wrong. But yeah, we'll talk about the pros and cons of doing that. And do I hodl forever? This is what some people think. Do I just forget about whether we're in a bull market or a bear market? Are there bear markets and bull markets, just like a stock exchange? And the long and short answer is yes, of course there is. There's always times of euphoria when everybody's piling in, and there's times of, oh my God, fear, and everybody wants to get out. In fact, we're going through one of those kind of big pullbacks right now. Now, you might be watching this in the future, but if you ever want to go back and check what the chart looks like on, I think it's May 22nd today, you'll see we just went through a face-ripping downtrend in the last 2 weeks, and it's painful, but I know we'll ride right through this. And in the future, we'll look back, and this will just be a blip on the chart, barely even noticeable. So the next question then is, if there is bull and bear markets, how will I know when the bull market is about to end? Like, are there signs that things are getting too frothy? Are there signs in the volume on the charts? Are there, the moving averages or whatever, that we're coming to the end of a bull market? Again, the answer is yes. And we'll talk about that in another episode. So what do I do when I know that we're about to go into a bear market, which is a long downward trending market that often goes on for a year, 2 years or so? And just as a foreshadow, you probably don't want to let all your gains evaporate slowly during that bear market. So there are some steps that I would suggest you do, and we'll talk about that in a separate episode. And then we're going to talk about one of the third types of coins, and that's a tethered coin. So what a tethered coin is it's tethered, most cases, to the US dollar. So you buy a coin like USDC or BUSD, and those things are always a dollar. And you might think, why would I buy a coin that's always worth a dollar? Why wouldn't I just sell my coin and get US dollars? Well, the reason is with fiat currency, the only way you're going to get interest is to take it to a bank or buy a bond or do something like that. And as you know, in this day and age, they're paying almost no interest. In fact, they're definitely paying lower interest than the inflation, which is not even the truth of inflation. It's much higher than they're stating it is. But even if we go by their numbers, the interest you're getting on any sort of bond or savings account is far below inflation. So you're losing money as you save. At least with a tethered coin, there are yield options that are high enough to be above even my realistic inflation rate. So what if we have hyperinflation? How does that affect crypto assets? Well, don't worry about that too much, because if we have hyperinflation, it is definitely going to hurt fiat currencies like their US dollar, because your purchasing power will evaporate. That loaf of bread will now be $10 and stuff like that. Most likely, an asset like crypto assets, where there's a set number of coins and the government can't print it into out of existence, they will hold up better, much like gold or silver. They will probably go up as inflation eats away at the purchasing power. In essence, the coins that have a set number of coins maximum will also go up in value because of the purchasing power. They may go up in nominal value, but they may or may not go up in real terms in purchasing power, but they'll do a hell of a lot better than the fiat currency that the government is presently printing out of existence. If there is this hyperinflation and they're trying to get confidence back, could the US come out with their own CBDC, a central bank digital coin? And if so, would they not just create this coin and then go, okay, well, now this is the only legal coin you're allowed to use. Every other cryptocurrency is illegal. Long and short on that, we'll do an episode on it, but I wouldn't worry about it, because a lot of coins are not just a store of value like Bitcoin. A lot of them are actually operating businesses where they're using their coin in essence as a currency to pay for services on their smart chain, their smart contract blockchain. And therefore, the US government can't just say, hey, you're a business we don't like because you use a cryptocurrency, so it's now illegal for you to run your business. So I don't think it'll ever happen, but we'll talk about that in a separate episode. And that's about all I could think of off the top of my head before I made all these videos. So right there, I just want to give you my email address, investingwithcraig@gmail.com. If after reading this list of the videos I'm planning to make, you think of something that I've skipped over that I should talk about, definitely put it in the comments below or throw me an email and tell me what you think I should cover as well. And if it makes sense to me, I will also add it in there. Of course, this isn't written in stone because I haven't made these videos yet. Okay, so let's get into tonight's topic, which is generally the intro. Intro is just what is a cryptocurrency or a crypto asset, and they are different. So let's get into that. I'll drop myself off the screen just so I don't block some of the text. I noticed I did that in the previous episode, or the previous screen. Okay, so what is crypto? Well, there are many different types of cryptocurrencies, but they all work on a similar backbone, so to speak. They're all a decentralized blockchain architecture. So blockchain technology is a decentralized ledger where, in essence, every person doing an action, whether it's transferring a coin or doing a new smart contract, is documented on the ledger and is kept on the ledger for anyone to see forever. Now, the ledger is kept up to date and accurate by things called nodes. Now, in the case of Bitcoin, the nodes are generally high-powered computers that are constantly doing calculations, and that's how they win new coins. But those nodes also have the other job, and that's why they win coins, of keeping the ledger accurate and up to date. So a transaction cannot be completed unless all nodes update their individual ledger and they all approve the transaction. In essence, everybody's individual ledger has to match or the transaction doesn't go through. So I've created a little diagram here so you can visualize what I'm talking about. So a transaction is requested. A block that represents the transaction is created. That block is sent to every node in the network. The nodes validate the transaction. As you can see, they all have a check mark on their computer screen, which means they all agree that that transaction is valid. And then the nodes, for doing this work, receive a proof of work reward, often in the case of a Bitcoin, but they don't all get one. I mean, it's kind of like, if it's kind of a lottery system. They all work on it, and then eventually somebody gets a coin, and in the law of averages, everybody eventually gets their coin. The block is then added to the existing blockchain, and then the transaction is complete. So just for the thought of anonymity, we want to mention that buyers and sellers of those making transactions through the blockchain are anonymous. This is done through an encryption key. The wallets where the cryptos move to and from remain anonymous, but all the transactions on the blockchain are public and permanently recorded on the blockchain. Since it is decentralized, there is no oversight body to go to if you want to dispute the transaction or if you lose your private key for your quote cold wallet. So in essence, if you lose your key or anything goes wrong or you feel like you got scammed somehow, somebody took coins that you were thinking was for a purpose and it didn't end up happening and you already gave the coins to them, you can't call the service department or IT or anybody else and complain. If you lose your password to your cold wallet, there's nobody to call that can reboot your cold wallet for you. So it's kind of like buyer beware, or just be super cautious of the fact that if you lose your key, you're screwed. If you get scammed or defrauded and you send somebody coins that you shouldn't have, you're screwed. If you sent your coins to the wrong wallet address, you're screwed. So that it's the pro and the con of being decentralized. The pro is if you have coins and I have a service, you and I interact without having to pay a bank or an intermediary, they're cut. It's efficient, it's cheap, it's great. It's the future of finance. Unfortunately, the only downside to that is there is no corporation in the middle to settle differences or to reverse transactions if they think somebody didn't do a fair job for what they were supposed to be paid for. Then yeah, that's the downside. So let's get on to the next thing here. So I talked about Bitcoin on a previous episode, so I kept this screen. We're going to use Bitcoin because it's the OG, the granddaddy of them all, the one that started it all. And it has a lot of the features that other cryptocurrencies since then have adopted. Some have gone a long way away from the way Bitcoin started, and some are pretty close, almost exactly clone copies of Bitcoin. So here's the features of Bitcoin. It has a limited supply. There's only a maximum of 21 million Bitcoins that will ever exist. Unlike fiat currency, where they can just print them and print them and print them, there's never ending. That's not the case with a Bitcoin, and that's why it's got value. They've done about 18.6 million coins right now, or maybe more by now. There's only ever going to be 21, so you think, oh, they're going to run out of Bitcoin soon. Well, no, because they are lowering the number of Bitcoins that they're giving to the nodes for doing this work, and so they don't think the last coin will be mined until 2140 or 2141 or something like that. So more than 100 years ago from now, it will be the last Bitcoin ever created. So there's no government backed. This is unlike fiat currency. It's purely digital. So this currency can be transferred across the globe in any size. So you could transfer $1 million from me to you across the globe, and there's no bank to go, oh, I don't think this is right. This is too much money, and whatever reason. You know how it is. I even have it with credit cards, that if you try and spend credit card on online things, they'll decide for you whether that's a company that you should be dealing with. They decide, nope, you can't use your credit card there. I get that all the time with cryptocurrency exchanges where they say, oh, if you want to get money on quick, use your credit card. And I think, I'll pay the 1 or 2% fee to put money on quick from my credit card. And inevitably, my Canadian bank just won't allow it. They decide for me that I shouldn't be buying crypto because it's too risky. So anyways, that's why I don't like having governments in the middle. It's decentralized. No single institution controls it. It's peer-to-peer. We talked about that already. Immutability. Once the transaction is complete, it can't be reversed. We talked about that already. And divisibility. I'll get myself off the screen here. Divisibility can support microtransactions. It's divided up to 8 decimal places. The smallest denomination on the Bitcoin is called a Satoshi, after the inventor, who nobody really knows who Satoshi really is, but that's the guy. That's what he called himself when he created it. So 1 Satoshi is I think it's 1/100 millionth of a Bitcoin. That's how small it is. So I still believe, even when Bitcoin was at 65,000, which was the all-time high, I still believe 1 Satoshi was probably less than a cent. So as you can see, very, very small transactions can be done with cryptocurrencies because they all have the similar architecture of this, where they have very, very small 8 or 9 decimal places. So one coin can be divided a gajillion ways. So you can, one day you could be buying a stamp with like 20 Satoshis or something. It's not going to be a problem at all. So when people say, well, we can't use Bitcoin as a currency because there's only 21 million in the whole world. Yeah, but 21 million times 100 million Satoshis. So you could just pay with Satoshis instead of Bitcoin. So it's not a problem. So this isn't that important to know, but there are various ways for crypto architecture to reward the nodes. There's pros and cons of each type. There is the proof of work, where computers solve formulas, and they often call it mining. And this would be the case of Bitcoin and the present Ethereum. They've been getting some flack lately saying that all these computers just chugging away for hours and hours at a time, just sucking up energy, is bad for the environment, even though most of the North American / Western mining firms are all using like solar, wind, hydroelectric. So, and they're helping the electric infrastructure by paying for off-peak power when normally you can't stop hydroelectric very easily. So when in the middle of the night when nobody's using it, these crypto farms can be using it, and that actually benefits the whole electrical ecosystem. But nonetheless, that's been the flack of the proof of work type of architecture, is that it uses a lot of computer power. Then there's proof of stake. This is the one that more of the modern coins are using. Proof of stake really works where if you want to be a node, it's not about having the biggest, most powerful computers to battle for the next Bitcoin. It's all about staking. So on Cardano or VeChain or Binance, what it is they say, oh, to be a node, you have to have, let's just say for argument's sake, 100,000 coins to be considered a node. And if you have 1 million coins, you're a higher level node. And there's more advantages to being higher. So what happens is most people don't have the 1 million coins, but what they'll do is they'll create a staking pool where one person will take the initiative, start it up, and then the other people will put coins into that pool and everybody shares the rewards. So that's what proof of stake is. And there's even one I've heard of where Solana is using called proof of history. It's the only coin I know that's using this, but long and short, this is just to show you there are different ways for nodes to be rewarded and therefore different architectures and infrastructures. It's not that important for you to know. It's no more important for you to know how your coin is rewarding their nodes or how its infrastructure is worked. You don't need to know how the electronics inside your phone work for you to be able to use your phone. And that's why I say this is just something because people in the news have been talking about proof of work coins like Bitcoin being too power hungry. And in case you get that argument of proof of work versus proof of stake, that's what it's all about. So there are 3 main types of cryptocurrencies or crypto assets, I like to call them, and they have different roles. So there's the one called the store of value, which is, this is the only time you should be calling it a cryptocurrency because they only have one role, and that's to be a store of value. That would be Bitcoin, Litecoin, and I guess if you have to really put Doge in there somewhere, I guess it's also a store of value because they don't have any smart contracts. There's nothing going on behind the scenes or underneath where other businesses are using that ecosystem to run their business. This is just simply like digital gold. So Bitcoin, you buy it with the expectation that it will be a great inflation hedge. If there's inflation, your coin will be worth more. So down the road, you'll have more purchasing power. You hope that your coin goes up a lot faster than inflation. And in the long run, over the 12 years that Bitcoin's been around or 14 years that Bitcoin's been around, it has far, far, far surpassed inflation. So that's why you would buy these type of things. Now, there still is the ability to stake these types of coins, but because they're proof of work coins and not proof of stake coins, they don't tend to pay as high because there's not that screaming desire to have these coins for staking reasons because that's not how new coins are minted. The next one would be smart contracts. These shouldn't be called cryptocurrencies. They should be called crypto assets because they're not designed to be, the coin isn't there to be a store of value or something for you to buy a t-shirt or a pair of running shoes with. It's meant to be a governance coin or a coin that is used to facilitate services on a smart contract system. And that would be things like Binance, which uses the BNB coin, or Ethereum, which has a ton of NFTs and other little companies that are running off the Ethereum system. And there's a ton more. The Cardano's coming out with it. VeChain has their own smart contract. Polkadot. I mean, most of the new modern coins that are coming out now are all proof of stake type of coins, and they're all going into a smart contract type of infrastructure. They're all battling. The only problem is, think of these coins as being like Microsoft operating system versus Apple operating system, where they don't work well together. They don't talk well together. So if you get yourself on the Ethereum, if you're a new AMM or a new NFT distributor and you're on the Ethereum network, it's harder to have people on the Binance network interacting with you. Now, there are some companies like Polkadot that are trying to create these bridges with parachains where one ecosystem can talk to the other ecosystem by going through Polkadot's ecosystem. It's confusing. But anyways, long and short, smart contracts are exactly that. They're a ecosystem created to facilitate services going back and forth. So that's that. And then there's the tethered coin that we kind of quickly talked about. Tethered coins are really just a coin in lieu of currency. Again, you could call them a store of value, but then they're really just pegged to the US dollar. So if you think that inflation's coming and the US dollar is going to lose purchasing power, then it's not a very good store of value. But what it has over fiat currency is two things. One, if you think the market is about to go into a bear market, you would jump into tethered coins because the other coins are going to drop a lot faster than tethered, which are tethered to the US dollar. And B, the yield on these coins is far, far, far above anything you're going to get with fiat currency. So that's why you would get into those. And the biggest examples of that would be USDT or BUSD, which is Binance's tethered coin, or there's another one called USDC, and there's one called DAI. There's a bunch of them, but they all have the same principle of being pegged to the US dollar. So those are the three main types. So one of the last questions I want to answer is cryptocurrency investing risky? And it's kind of a yes and no. It depends on the crypto, for one thing. Of course, we talked about you want to research everything before you buy, because as we talked about, there's all different types of coins with all different use cases, and there's not much cost involved in creating a brand new coin. So you'll get these weird ones like Shiba Inu that's really just a copycat of Dogecoin. It comes out of nowhere. There's no smart contract built into it. There's no nothing. It's simply a meme coin created to hope to get the hype off of Doge and it to go up in value. And for some people, it will work out fine. They'll buy it and it'll go up in value and they'll sell it and they'll feel brilliant, right? I bought this coin. It wasn't because it was a good coin or it has a good project team working on it. It's just a case of the hype was going in the right direction. But you got to always do your research. So yeah, there are terrible coins out there because anybody can create a coin for almost no money. So do your research. So yes, it can be risky, but something to factor in. Cryptos are volatile, and people often equate volatility with risk. So volatility means the thing shoots up and shoots down and shoots up and shoots down. That's volatile. But as I'm using this example, if on a regular basis, a coin goes up 60% and then on the pullback falls 40%, and it keeps doing that, over the long run, you're doing this, but you're going up, right? So if you think of it as a long-term investment, it's not risky. It's volatile. There's a difference. So volatility shouldn't really be confused with riskiness. Risk should really be, what are the chances that if I invest in this coin, I'm going to lose all or most of my money? And those would be I call it, well, this is a common term. I'm not trying to be rude here, but they're called shit coins. So that's a term you'll often hear in the crypto YouTube world or in the crypto space. You're going to hear the, buying shit coins, which means coins that have absolutely no developers working on it to improve it. There's nothing going on behind the scenes. Somebody creates a coin, and for whatever reason, the Elon Musks of the world tout it as the next best thing, Dogecoin being prime example, and it takes off. And then people start investing in it, and anyways, it is what it is. But yeah, so if it's a coin that you could wake up tomorrow and it's worth zero, like a Shiba Inu or whatever, these kind of coins where there's no fundamental reason to have this coin around, then I'd say yes, it's risky. You might, like spinning the roulette wheel, you might invest in it and it goes up tenfold and you feel like a genius, but you could also wake up tomorrow and it's worth nothing because some news story might come out that the developers have taken off with a third of the money that was, deposited. You get my point. So it could be an all or nothing proposition for you. So there you go. That's tonight's episode. So you saw the roadmap of what I'm planning to do in the future episodes. Again, this one went a little longer than I probably would have liked, but I had to give you the roadmap first before tonight's What is a Crypto episode. And then let's go back and just quickly talk about what's coming up in future episodes. Again, tell me in the comments if there's something you think I'm missing. We talked about what is a crypto. We're going to be talking about where to buy it. We're going to talk about how to set up your wallet. We're going to talk about, MetaMask is in particular, what's the best research you can get for free? What's the best charting system you can get for free? What are the differences? When would you just hodl your coin, and when should you be trying to invest it to get passive income? What's staking? What's yield farming? What's auto yield farming? Does it matter which yield farm? You already know the answer. Yes, of course it matters. Do I hodl forever? You can. If that's your thing, if that's your game, you don't want to even risk putting it on a yield farm, you could just hodl, which is hold on for dear life. There are bull and bear markets. We'll talk about what we do when we end a bull market, what we do when we're in a bear market, and when you use tethered coins. If we're hyperinflation, does it do anything? And is there any chance that it's going to get outlawed? So there you go. Those are the topics that are going to come in the future. Hopefully you're looking forward to that. Again, love to hear your comments down below. Also, anything long-winded you want to talk about, send me an email. And that is it. So hopefully you enjoyed it. If so, show the channel some love by giving a thumbs up. Subscribe if you haven't already. Hit the bell notification so you know the minute a new episode has come out. Hit me up too on Twitter, or I was going to say Instagram, but I don't actually have an Investing with Craig Instagram. I do have a Cruising Off Duty Instagram. But yeah, hit me up on Twitter. I do tweet out things from time to time when there's news that I think is relevant. I don't have as many followers because I just started that Twitter, so it's always nice to get more followers so you're actually tweeting to more than 10 people. But it is what it is. New channel. All right, that's it. Oh, and that sub number is not right. It's higher than that now. I just didn't update that. So that's it. Craig signing off, wishing you happiness, health, and wealth in that order. Ciao for now.